Inside the world of stock market manipulation. Have you ever wondered how some people manipulate the stock market to make millions while leaving others to face devastating losses? What are the secret tactics used by these players, and how can you, as an everyday investor, protect yourself from falling into their traps? For a long time, the stock market has been a sign of economic growth and potential. It gives regular investors a chance to get rich. But there is a dark side to the stock market, where dishonest people change prices to make money for themselves, often at the cost of small investors. These tricks can make people less trusting of the financial system, mess up markets, and cause investors who don't know what's going on to lose a lot of money. What is manipulating the stock market? Stock market manipulation is when people or groups do things on purpose to change the price of a stock or the market as a whole. These things are usually against the law and are done to make fake demand, raise or lower prices, or trick other buyers into investing money that they don't have. Even though watchdogs like the U.S. Securities and Exchange Commission, SEC, look out for and punish cheating, it's still a problem in markets all over the world. There are a lot of different ways to manipulate people, from sharing false information to setting up complex trading plans. At its core, stock market manipulation takes advantage of how the market works and how investors are weak. Common ways to manipulate the stock market. Pump and dump schemes. One of the most well-known types of market manipulation is called pump and dump. This is when people falsely raise the price of a stock through hype or misleading comments, then sell off large amounts of stock when the price peaks. Manipulators buy a lot of a stock that isn't very expensive or isn't easy to sell, and then they aggressively push it in newsletters, online forums, social media, or even through coordinated messaging campaigns. This pumping makes it look like there is demand for the stock, which drives up its price. When the price hits a certain level, the manipulators dump their shares for a profit. Investors who didn't know what was going on are left to lose money when the stock crashes. In 2014, some traders used fake emails and news releases to make the prices of penny stocks seem higher than they really were. This tricked thousands of investors. The SEC charged the criminals, but many people who lost money never got it back. Spoofing and layering. Spoofing and layering are both ways to trick the market by putting in fake orders that give the wrong image of supply or demand. A trickster puts in big orders to buy or sell that they don't plan to carry out. These orders give the impression that the market is very active, which leads other buyers to trade based on what they think are trends. Once the market responds, the manipulator drops their fake orders and profits from the changes in price that happen as a result. A case in point, the well-known flash crash of 2010 took out almost $1 trillion from the U.S. stock market in just a few minutes. Later, investigators found that a trader had manipulated the futures markets by spoofing, which added to the high volatility. Short and warped. Short and distort is the opposite of pump and dump in a negative way. In this case, people who try to lower a company's stock price by spreading false or misleading bad news about it make money. Short trades on stocks are bets that the price of the stock will go down. Their next step was to share rumors, fake news, or false information about the company's problems or scandals. As fear spreads, the price of the stock falls, which lets the people who are manipulating it make money from their short holdings. Dealing in wash. Wash trading is the act of artificially increasing the number of trades in a stock to make it look like there is a lot of activity or demand for it. How it works. People who want to cause fake volume place a lot of buy and sell orders for the same stock at almost similar prices. Other buyers are drawn to this activity because they think the manipulated volume is real market interest. Trading on inside information. Insider trade is using secret information to make money, but it's not always manipulation in the strictest sense. How it works. Insiders, like executives or workers, trade stocks based on secret information like when an earnings report or merger is due. This gives one side an unfair edge and hurts the integrity of the market. Well-known cases of manipulating the stock market. The Wolf of Wall Street. In the 1990s, Jordan Belfort, the notorious Wolf of Wall Street, used his brokerage business, Stratton Oakmont, to run huge pump-and-dump schemes. Belfort went after penny stocks and used pushy sales techniques to get people excited about them before selling off his holdings. Before regulators shut down the business, the activities of the company scammed investors out of millions of dollars. GameStop and the social media boom. In 2021, Reddit's r/Wall Street Bet site caused a stock market craze that centered around GameStop. Even though it wasn't a typical manipulation, the event showed how group action and speculative hype can cause price changes that are hard to predict. Hedge funds that sold short GameStop stock lost billions of dollars, but individual investors either made a lot of money or lost a lot of money, depending on when they bought and sold. Here are some ways to keep yourself safe from market manipulation. Even though market manipulation isn't always easy to spot, regular buyers can take steps to keep themselves safe from these schemes. Go ahead and do your own research. Don't just follow the advice on social media, forums, or emails. Cross-check the information with reliable sources, business filings, and financial reports to make sure it is correct. Watch out for strange hype. It could be a sign of influence if a stock is being pushed hard without any clear reasons for its rise. Don't chase stocks whose prices are going up quickly for no apparent reason. Keep an eye on the trading volume. Pay attention to how many times a stock is traded. A sudden rise in volume that doesn't match up with news or events can be a sign of wash trade or spoofing. Build a diverse portfolio. Diversification lowers the chance that you will lose a lot of money on a single stock. A well-balanced portfolio can help protect you from risks like market manipulation and others you can't plan for. Know how the market works. Learn about how the market works, such as how orders are carried out and how stock prices are set. Knowing how these things work can help you spot problems. Put in place stop-loss orders. You can reduce possible losses by setting stop-loss orders. This tool will sell your shares immediately if the price drops below a certain level. This will protect your investments from sudden drops in value. Measures taken by regulators to stop manipulation. Regulatory bodies such as the SEC, the CFTC, and their foreign counterparts are very important for finding and prosecuting people who manipulate the market. These groups keep an eye on trading trends and look for strange activities by using high-tech surveillance tools. Also, researchers are looking into new technologies like artificial intelligence and blockchain to make markets more open and less likely to be manipulated. Regulators have to change with the times to deal with new problems that come up, like those caused by social media and decentralized platforms. If you want to stay ahead in the world of investing and uncover more insights like this, make sure to hit that subscribe button and turn on notifications.